What's up everyone, my name's Robbie. This is Robbie in Manila. And today we're talking about my favorite stock ratios for beginners. So back when I was a financial advisor, a lot of people would ask me, they'd say, Robbie, how do I find stocks to buy? And so one of the things I would tell them is that you should probably learn some easy, basic, beginner stock ratios. And so what I'm going to go over today are ratios that I think are good for people who are starting to invest or don't really know about stock ratios yet. This is by no means like an inclusive list of all the stock ratios that you should ever learn. This is really just if you're starting out, if you're trying to figure out how to invest, how to find stocks, these are the ones I would just start with. Now, before we get into this, I need you to understand there is absolutely no magic stock ratio. There's not one that you can look at and say, hey, I should buy this stock because this stock has this ratio. It doesn't exist. These ratios can help you figure out what type of stock you're investing in. It can basically sort it into a category of different stocks based on ratios, and it can help you compare the ratio of this stock that you're looking at to its maybe competitors or what you would say like comps or comparables, which we'll go over later. Okay, so when it comes to ratios, you can actually group them into 5 different categories, and I think knowing that they're in 5 categories will actually help you understand which ratios you're using and why. So the first group of ratios are market value ratios, or you might call them just market ratios. And market value ratios involve using the stock price of a company. The next category of ratios are called profitability ratios. These can help you understand profitability in things like operating margin, gross margin. Anyone who's a small business owner might be familiar with these two things. The third category of ratios are efficiency ratios. And efficiency ratios can help you figure out if a company is being efficient with its assets. Coming up at number 4, we have leverage ratios. And these can help you figure out how much of a company's capital is actually coming from debt. And last but not least, we have liquidity ratios. This can basically help you understand if a company is cash flowing its operations and future obligations, or if it's going to need to raise money using debt. Okay, so those are the 5 different categories, and lucky for you, if you're a beginner, there's only 2 different categories that I think we should focus on here, and those are the market value ratios and the leverage ratios. And so in total, we're going to go over 6 different ratios that I think beginners should probably learn when they start investing in stocks, and we're going to do that after the intro. All right, so let's go ahead and get into these different ratios, but I'd love to hear from you in the comments. Which of these ratios you already use? Let me know. I'd love to hear from you. So the first ratios we're going to go over are the market ratios, and actually they make up 5 of our 6 different ratios we're going over, so the majority of these are market ratios. So the first ratio I have on the list here is called earnings per share, also known as EPS. This is a pretty important ratio, and you're going to see it written all over the place, and one other reason that it's important is because you can use it to basically figure out the price to earnings ratio, which is another one that we're including here. Earnings per share basically shows you how much a company earns for every share of stock that they have outstanding. Okay, so here's a little bit of a hurdle when you're starting out with all this different stuff in the stock market. There are a lot of terms that actually have multiple different terms for the same thing, and it makes it kind of confusing, unfortunately, when it comes to investing. So when it comes to earnings, earnings are synonymous. They're the same as the net income of the company. Where do you find net income or the earnings of the company? Well, you go to the income statement, which is one of the financial statements that these companies file, and you go to the bottom. It's usually one of the last lines, and it says net income. Well, net income is earnings, so basically that's what you're looking for. And so earnings / net income is basically what a company makes after you subtract all of its costs and all of its taxes and depreciation and all of those things until you get to that bottom line on the income statement. That is where you get the net income or the earnings. So there's a lot of places you can go to find financials. You can go to Yahoo Finance. You can go into your broker probably. So Charles Schwab, Fidelity, Vanguard. These places all have financials for you. It's pretty easy to get this stuff. I'm on a website called quickfs.com. It just, to me, this website kind of makes things kind of easy to see. It's free if you don't want to do anything advanced. You just need to like sign up for an account, which is free, so just log in and stuff. So I'm on quickfs.com. I'm just going to type in Nike, and this is what we have. So what I'm going to do is I'm going to go to the income statement because I'm going to go try to find the earnings or net income. I'm going to go kind of down towards the bottom of this income statement, and you see this is the net income, and these are the years. Okay, so for 2021, the net income of Nike, $5.727 billion. So we found net income. The next thing we need to do is find the shares outstanding. So in QuickFS, just here in the balance sheet, you can actually see it already tells you the earnings per share. So that's always easy to do, but we're going to calculate it just so you understand how to do it. So in quickfs.com, you actually can see down here where it says shares, and then you have basic and diluted. I'm not even going to get into the details of those two. Like, this is for beginners. Don't worry about it. Just let's go with the basic to start. Basic shares, and this is how many shares Nike has outstanding. 1.573 billion shares outstanding. So then how do we find the earnings per share? Well, we need to just divide the earnings of the company divided by how many shares they have. So there's net income, also known as earnings, that are 5.727 billion. So that's how much they earned. And we divide that by the amount of shares there are, and you're going to get the earnings per share, which, by the way, you can see already here, they already listed out for you as $3.64 for every share outstanding of Nike. And so what does this help you do? Well, it helps you do a few things. So first, it helps you kind of understand for every share of Nike, Nike makes that much money. So $3.64 for every single share. Now, what you need to do though when you're looking at earnings per share, it's really about how it goes up or down over time. So what you want to do is make sure that earnings per share is going up over time, and if it's shrinking for some reason, then you need to kind of figure out, why is it shrinking? Is there a reason it's shrinking? Is it still a good buy if the company is actually losing earnings, or is it not? So basically you just want to look at over time what's going on with the earnings. And by the way, something great about quickfs.com, you can just go over to the overview page and it's going to show you the percentage of earnings per share over time. So you can just see right here, it says EPS growth, and you can see how it's performed over time. Okay, next up we have the PE ratio, or the price to earnings ratio. That PE ratio is really a popular one. It doesn't mean it's like the best one. I mean, there are definitely ratios that are probably better, but PE ratio is the most used, probably I would say, on the news, and when you read different articles. PE ratio is a very highly referenced ratio. So calculating PE ratio is pretty easy and actually uses what we just talked about, so earnings per share. So to find the PE ratio, you just take the price that the stock is selling for, divide it by the earnings per share. So to find the PE ratio, it's pretty easy. We'll just go back to quickfs.com. We'll look here, it says the last close, $165.09. So we just take that number and we divide it by the earnings per share. The earnings per share were $3.56. So that equals 45.5. That is the PE ratio. So what does this actually tell us? Well, it tells us that, the earnings of Nike were $3.56. We figured that out. That was the earnings per share. Now, it's telling us that the price of the stock is trading at 45.5 times earnings. 45.5 times $3.56. But the thing is, that doesn't really give us any context. So who cares? So 45.5, what does that mean? That's what we need to figure out. You see, when you look into a PE ratio, you really need to look at the industry that you're looking at and its competitors. So we might call this comps or comparables, or what is it being compared to? And so that is an important part of investing. And so that's what we need to look at. So we can actually see here, and I got this off of charlesschwab.com, and you can get this in other places too, but this is basically just looking at some competitors of Nike. And so what you look for, and you kind of say, what is the PE ratio of these other companies? Well, we see that Nike here has a PE of 44.86. I looked at this the other day, so it's a little bit less. But now we look at Under Armour, for example, which is, I'd say, a pretty close competitor to Nike. So UAA, Under Armour Inc., and then you say, what is the PE ratio of Under Armour? Well, it's 86.79. So what's happening is Under Armour is selling for a larger multiple. It's more expensive than Nike. Then you have to go and say, is that something that you think should be true? Should Under Armour really be selling for that much more, almost twice as much of a PE ratio, or should it be selling for less? Or should Nike maybe be selling for a larger PE ratio? And so if you think it should be selling for a larger PE ratio, maybe Nike's a buy. The other thing you might want to look at is the history of the PE ratio. So you might look back and say, is it selling for a lot more than its historical PE, or is it under it? And that could also be kind of a sign of whether or not it's good or bad buy. Moving on to our third market ratio, we have the price to book ratio, or the PB ratio. This is another one of those weird ones that have multiple meanings. So the book value of a company is actually the net worth of the company. So they're the same thing, book value and net worth. Now, unfortunately, this is one of those ones that have three different ways. So it's also said as the shareholders' equity. So you got to make sure that you understand shareholders' equity, net worth, and book value are the same thing. So let's go to quickfs.com and find the book value of Nike. So what I'll do is I'll go over here to the balance sheet. I'm going to scroll to the bottom. And I'm going to see where it says shareholders' equity. And like I said, shareholders' equity is the same as the net worth, which is the same as the book value. So now we have to say, what is the book value for every share of Nike, like we did with the earnings per share? So we're going to go ahead and we're going to divide this net worth / book value / shareholders' equity. We're going to divide it by the shares outstanding. And so around 12.8 billion in shareholders' equity or book value divided by the number of shares, which is 1.58 billion, and that's going to give you a book value per share of 8. Then you divide Nike's share price by the book value per share, and you're going to get a price to book value of around 20. Again, we're going to go look at some of the competitors to see what's going on there, and so let's look at Under Armour's price to book value. And so here we can see that Under Armour's price to book is actually 6.71, so it actually has a lower price to book value than Nike does. And so this is kind of interesting, right? So now you have Under Armour, which has a higher price to earnings ratio, but a lower price to book ratio. So you just need to kind of decide why this is, and you basically got to look more into the company and understand the company, the business model, and what's going on. Okay, so let's move on to our fourth ratio. So the fourth is the price to sales ratio. This one's pretty easy to understand. Just like the other two, we just need to find the sales of the company, aka the revenue, convert it to a per share number, just like we did before, and then we're going to divide it by the price. So back to quickfs.com, we're going over to the income statement. Here we have revenue on the very top, and that's our number, 44,538 million. So that's our number. We're going to divide that by the total shares outstanding of 1.58 billion. And we get sales per share or revenue per share of about 28. Again, we're going to just get the price of Nike, $165. We're going to divide that by the sales per share. And it's going to give us a price to sales of around 5.8. Again, on quickfs.com, you can see 5.8 right here, and that's the price to sales. You can always find these numbers pretty easily there. It's just good to, figure out how to calculate them so it helps you understand what they are. Again, we're going to go in and we're going to compare this to, let's say, Under Armour. So we'll look at Nike. Nike has about 5.67. Remember, this was the other day, so numbers a bit different. And then we have Under Armour of 1.76. So Under Armour is not selling at a very high multiple of their sales, which then makes you think, why is the price to earnings ratio so high, but the price to sales ratio is actually low, and the price to book is kind of low? So then you want to look into why that is. You may look at this thing and it might turn out that you end up liking Under Armour for some reason. I don't know the reason why Under Armour's multiples are lower in price to sales and price to book, but higher in price to earnings, but I would want to know that. So now moving on into our fifth ratio, we have the dividend yield. This is one that's used by a lot of dividend investors, so this is probably going to be very important for you to understand, and it's always good to know the yield of a dividend that a company you might be investing in is paying. To get this one, we need to get the dividends per share. I'm actually going to get a little lazy now, and I'm just going to go look up dividends per share on quickfs.com. Dividends per share right here, and we have $1.07 for every share you own. So for every share you own, you're going to get $1.07. So now we're going to just divide this by the share price, and that's going to give you the dividend yield. So $1.07 divided by $165.09 is going to give you a dividend yield of just about 0.64%. So actually Nike does not have much of a dividend yield. It's kind of low. So if you're really a dividend investor and you really rely heavily on yield, then Nike might not actually be a company that you're really interested in. Now there is the other side where a company might actually pay too high of a dividend. And in that case, you might actually want to make sure you maybe steer clear of that. Moving on to our final ratio. This is different than the ones we've been going over. Those are all market ratios. This is a leverage ratio. So our leverage ratio that I think is important to beginners is the debt to equity ratio. I think this ratio is important because I think you should always factor in how much debt a company uses. And so this will help you kind of see the debt load of a company. So to find the debt to equity ratio of a company, you'll add up all the debt. So the short-term debt, long-term debt, and also something called fixed payments. And so to get that, we're going to go back to quickfs.com and we're going to find it on the balance sheet. So first I'm going to look for short-term debt, and I see that in 2021, Nike only has $2 million in short-term debt. In long-term debt, they have $9.413 billion. So all I need to do is take the total of all the debt, which is just around $9.4 billion, and I'm going to divide that by the net worth of the company. If you remember price to book value, there's the net worth slash book value slash shareholders equity of the company. And so I take 9.4 and I divide it by the net worth of Nike, which is about 12.8 billion, which we got from the price to book value. And that equals a debt to equity ratio of only 0.73, which is really good. So what this means is that the total net worth of the company is more than all of the debt that the company has. When this number gets into like the 1.6, 1.82 range, that's when I kind of start getting worried, because it means that there's more debt inside the company than the entire net worth or book value of the company. So I like to see this under 2 for sure. A lot of times actually I would prefer it to be even lower, but again, it really depends on the capital structure of the company, what's going on, is it growing, is it not growing? So things to take into consideration, but it's always good to know the debt to equity ratio. So that is it. Those are our 6 different ratios that I think beginners should learn when they start investing. Remember, I would love to hear from you in the comment section below which of these you've used, which you're gonna use, which you like. Just let me know. I'd love to hear from you. And don't forget, of course, hit the like button if you like this, and subscribe if you want to see future content like this. And got another video coming up on the end screen. Probably should watch that right now.